goes by Adley_ETH on Twitter. Current handle is not here, an anonymous account. Great. I retweeted it. You can scroll through my tweets from earlier this week if you want to find it, or you can look up the original author. Great little thread about what this trade was. So let me talk about what this was. On FTX, on the exchange, they had a couple of tokens that were listed that were synthetic trades. So for example, one of them was gave you daily leverage of an underlying cryptocurrency. ETH Bull was the name of one of the tokens. And if you bought it, it would give you 3 times the daily return of ETH. Well, how is that achieved? Well, they actually had to go in and buy futures every day and reset that leverage to buy the appropriate amount of notional exposure so that at the end of the day, you got exactly 3 times the return. Well, FTX decided that they were going to publish the schedule with which they were going to do this rebalance, right? And it happened at 00:02 UTC every single day, which I believe is about 8 p.m., 8:02 Eastern. And the trades would start firing off, and you could actually calculate based on the assets that were held tracking the token, which you could use their API to figure out, and the prior day's move, how much they were going to have to trade to rebalance. And you knew exactly when they were going to trade. And you knew exactly how they were going to trade. Because if you watched this for a while, you saw, oh, they do a blast of about a certain amount of money and then wait 20 seconds. And then a blast of another amount of money, wait 20 seconds. And then it was every 7 seconds or so. And so what that gave you the ability to do is say, I know who is across the table from me. I know exactly what they're going to trade. I know exactly how much they're going to trade. And I know exactly when they're going to trade. And that gives me the ability to potentially front run that trade and provide them liquidity. And so that edge existed for a really long time. And then this is a great story about like the transformation of edge too. Because once enough people caught on to that, people started front running the front runners, right? And this is how edge disappears. And so then for me, when I was playing this, I stopped trying to front run the trade. I knew that everyone would be trying to exit the trade. So I started to try to go the opposite direction, which was to play the mean reversion trade, knowing that everyone was trying to exit. And so there's all sorts of ways this can be played. It was such a fascinating little microcosm of history, but I think it's such a great example of when you're poking around for edge in the markets. And this is the type of stuff that can never be bundled up in a mutual fund or an ETF. This is just like, this is intraday trading stuff. This happened over a minute. What a great history lesson in like what an actual edge can look like. And the things you have to consider, like how big were these moves? They were 50 basis points, 100 basis points. Well, now all of a sudden execution really matters. You know, you do taker fees and you're paying 10 bips to cross the bid-ask spread. All of a sudden you're eating into a huge amount of your profit. All that stuff starts to matter. But this was such, to me, a great isolated example of what an edge truly is in its purest form.
There's so many things that, like, I think about, for a lot of time, people are trying to front run JP Morgan's hedged equity, right? And they started trading the strategy style a little bit that threw a lot of people off. Or what works great on that is like 60% of the time, works all the time, is like, it's worked the last 5 times out of 5, and then they change it up on you for the 6th. Then you've taken on a bunch of leverage because you thought it was a sure bet. And then, like you're saying, even with like somewhat edges and seasonality, like you said, once everybody, especially the academic papers come out, that ARB's completely gone. But like also people have been front running it and moving it, closer and closer in time. And if I recall correctly, I remember when you were doing this, is like, yeah, you kind of figured out, but you kind of backed into it, didn't you? Did you figure it out by just seeing the trading volume one day? And then you figured out that that's when they were rebalancing? I can't remember exactly when you...
I was doing some work around these perpetual futures and their reset period. I don't remember what clued me into it, but FTX very clearly had on their website, like the schedule was there for all to see. Talking about if you looked into these tokens. So like, this was one of those cases of like, this wasn't even a hidden trade. This was like out there, available. Anyone who took the time to learn what was trading and how it traded, potentially had the opportunity to see like, yeah, that could move markets. And we laugh at how we sometimes, like, traditional finance looks at crypto and is like, oh, how childish. This is exactly how levered ETFs work, by the way.
Yeah, exactly.
But
exactly.
most of the time, they just do a market on close
I
order.
was about to say that's the way around. The workaround's the market on close.
Right. And so how do you do that when markets don't close?
Right.
It's a non-trivial problem. The other really interesting thing that happens here is you typically, when you're talking about building these products, you don't want to ever have an amount of leverage that you're going to hold over a period where the product could fall an amount equal to 1 over the leverage. So if you have 3 times leverage, you don't want to ever just hold it naked over a period where the product could lose 33%, 1 over 3. You know, if you have 2 times leverage, you don't want to hold it over a period. It could lose 50% because that's how you get wiped out. Well, crypto is the type of asset that can move 33% in a day, right? So if you had this 3 times levered product, they actually then had to introduce intraday rebalances. So it got to the point where actually you had to track this throughout the day and figure out, was it going to rebalance? Well, that's another time you might be able to play the edge. And then at the end of the day, if they had already rebalanced intraday, you know, is going to affect the amount that they're going to rebalance at the end of the day. But these sorts of, again, like they're minor complications, they're important complications, but for the most part, the edge was there for all to see. We knew who was trading. They were you knew they were going to trade. It's not like they just ever decided not to. It was completely programmatic. You knew the direction they were trading. You knew the amount they were trading. You could look at the order book, estimate how much impact they were going to have if you wanted to take it that step further. And by the way, they were doing this across dozens of tokens. And so you could diversify the way you were trading.
You already answered some of my other questions because I remembered at the time, like you showed me, like you said, when it was at 8 p.m. And then I think at one point they started doing it twice a day and then throughout the day. So you're looking at those different times. But if I recall correctly, I remember you're showing me in live some of the times is like it didn't work every time, or that's when everybody kind of glommed onto it, where then they started coming shorter, but like it wasn't. I think you would show me like 4 out of 6 times or something it worked, but it hadn't worked.
It definitely wasn't guaranteed to work every time. Right. It largely depended on what was happening in the market. If there was activity going on, it depended upon what the order book looked like. It got a little weird sometimes too, because the way these tokens trade is they're sympathetic movements, right? I don't know, Cardano might be highly correlated to ETH. And so what happens if Cardano was actually, the levered token was supposed to sell down, but ETH was buying? Well, was Cardano's downward sympathetic movement actually going to get offset by the correlation trade and how correlated it is to ETH? So there were definitely complications there. I think the author of the Twitter thread made it sound easier than I think the trade really was, but they might have started trading it long before I did. Maybe they were just smarter than me.
Yeah, because I think that where you eventually got to too. Yeah, you were looking at the correlation trade because you'd be like, ETH moved this much last time, so I'm going into this one. Like a correlation trade would say Solana or whatever it was. Like, isn't that what you eventually got to? And I'm thinking about too you, and then what you pointed out too is like after figuring all that out, then you start playing the mean reversion after the event, right? So what was the event? Right. 2 to 5 minutes? Like how would you also, that's a execution time frame where you got to jump on that mean reversion too. So how did you manage that?
Yeah. So again, it all largely depended on how much was actually trading. Like if they were having to execute an amount that was going to take 2 minutes of buying or 2 minutes of selling, right? The mean reversion, you know, you might be delayed your execution 2 minutes and then trade for a minute. So a lot of it was dependent upon how much volume they were dumping into the market and how much the market moved at that time, right? Because you don't want to take the mean reversion trade if they're dumping a very small volume and the market doesn't move at all. There's not going to be a mean reversion trade, right? But it got to the point, by the way, that the mean reversion trade wasn't about what they were doing. The mean reversion trade was about everyone front running what they were doing. Because if everyone front runs that trade and then tries to provide liquidity into it, it's a question of who's the leftover bag holders. Was there too much liquidity bought to sell into it that now people have to close their positions? It gets complicated, right? It's a constant arms race. But again, the core point I want to get back to here is not like this stuff is super complicated. It's the nature of Edge, right?
Yep.
And in this case, you know a party who has to trade. You know exactly what they have to trade, when, how much. That is hugely valuable information in terms of trying to identify an edge. And I think the more we move away from that, right, the less we know about who the counterparty is, why they're trading, what they're trading, and when they're trading, the more it goes from like a pure edge to a statistical edge, right? You still might be able to find these statistical anomalies but you just have far less certainty about them, that they're going to continue to exist, or that you can purely quantify the nature of them, the less you can answer those specific questions.